Hi, I'm Grant Mundell, Investment Specialist with Equity Trustees with the May monthly update. Investment markets performed very well over the last year, and in May, global equity markets rallied further, supported by robust US corporate results and lower US bond yields. Again, it was US equities that was the key driver, with the S&P 500 rising 4.8% and Nasdaq surging 7%. US corporates continue to surpass expectations, reporting another solid set of quarterly numbers. Q1 earnings grew by 7.8% year on year, with tech sector earnings proving most resilient again. Otherwise, company management focused a lot on costs. Investors remain very optimistic about the future runway for artificial intelligence and data demand. The Magnificent Seven, which refers to companies such as Google, Microsoft, and Apple, continued their ascent up another 9.1%, with chipmaker Nvidia, the notable performer, up another 27%. Remarkably, Nvidia is now worth more than the entire German stock market. The ASX 200 rose 0.9%, but underperformed international equities, impacted by a stronger than expected inflation read and a weakening consumer, which was borne out in a number of company announcements. Strong migration numbers have shielded underlying weakness on a per capita basis in Australia, while the baby boomers are proving more resilient than younger demographics. IT was the top performing sector locally and offshore, but utilities also performed well, supported by higher power demand from data centres caused by the shift to AI. In Australia, the financials also performed strongly due to a solid set of results from 3 of the 4 major banks. The major bank results were solid relative to expectations, benefiting from the resilient economic environment. Low bad debts and strong capital positions led to a capital management announcements across the board. Along with the banks, insurance stocks are rallying, benefiting from strongly rising premium rates across a range of categories. In other asset classes, Australian bonds were broadly unchanged. Australian listed property securities rose 1.9%, and commodities broadly rose, although oil continued its recent slide. In economic news locally, the RBA kept rates steady at 4.35%, while the April inflation rate of 3.6% year on year was slightly above expectations. A second consecutive budget surplus delivered cost of living relief to households, but arguably could be seen as inflationary into 2025. But the economy is slowing. Notably, the unemployment rate rose to 4.1%. Consumer confidence measures remain subdued, while construction activity, retail sales, and building approvals were soft. Separately, in the US, economic data is similarly slowing, and Federal Reserve governors remain watchful of inflation, unconvinced we have seen enough slowing to enact rate cuts. Also, the Biden government announced they will increase tariffs on a broad range of Chinese goods, which may have ramifications on inflation. The Fed's fund rate was unchanged at 5.5%, and at this point, the market is pricing in a rate cut in the US in November. The unemployment rate rose marginally to 3.9%, and the housing market continues to slow, with new home and existing home sales falling. In China, the economy continues to be impacted by the weak property sector. Steel production weakened in April, while May manufacturing and non-manufacturing data also disappointed. The credit impulse remains weak, although policymakers have initiated processes to soak up the oversupply in the property market. Lastly, in Europe, data supported views that the European Central Bank will cut rates in June. So where does that leave us? Well, equity markets have performed very well over the last 7 months in particular, and are mildly expensive with underlying economic growth slowing. While inflation remains somewhat sticky, rates will have to remain on hold, which will continue to act as a handbrake on economic growth. There are a narrow subset, however, such as tech, where earnings have been strong. While forecasts point to a recovery in earnings growth in FY25, to get inflation back to the target range, economic growth may need to slow further, creating the risk of weaker than expected revenue and earnings. With equity valuations relatively full, this could see equity markets retrace, and therefore we're a little bit wary in the short term and remain mildly defensively positioned, waiting for a pullback in equity markets to deploy excess cash. In Australia, we think that our quality at a reasonable price process suits the current macro backdrop, where we look to buy companies that are well managed with strong balance sheets, industry structures and pricing power to deliver strong earnings at a reasonable valuation. This process has historically proven to keep up with the index in rising markets but outperform in falling markets. And we would note that the return outlook for other asset classes such as listed credit, fixed interest and cash remains solid at between 4 to 7% over the course of the next 12 months, depending upon what product you might be exposed to.